Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter. 8 years and running and celebrating 31 years serving proactive North Central Florida savers and investors. The team from GulfCoast Financial Services and founder and CEO John Kuykendall here with us, as always, providing a dose of common sense and helping to uncomplicate the financial world. Now, John, a big part of that is understanding all of the choices and options that we have available to us, which are plentiful. There are many different options out there for where to place our money and what tax status to choose on those dollars. So today we're going to spend a little time trying to simplify that and break those options down.
Well, that's right. There are a lot of options and a lot of people don't understand them. Over the years, a lot of us were never taught finance in school. And so when we graduated from high school, we didn't have all of the programs that they have today. And so I think we're limited a lot of times in our knowledge, Peter, and we do what we're used to, what we think is safe, but sometimes it's not necessarily the best thing for us to do tax-wise.
Well, tax-wise, we're going to get there because that is a big part of all of these choices and decisions, making the best tax decisions with where to place our dollars. But we've got different locations for them as well. And the tax status is sort of the shelter under which we place certain investment choices and options and different types of accounts. So we'll certainly get there. Important. But John, starting out, many of us first begin earning income, and then the most common first place that we go with that money is down to the bank. The bank never really loses its value or importance as being a place to put money, but there's also a limit on how much we probably want to place there.
Well, that's right. Banks traditionally don't pay a lot of money for what most people have commonly, which is a checking account. Even though checking accounts can pay interest these days, they don't pay a lot of interest, and historically they've been very low in interest. So while it's a great place to park our money and have it liquid and have the convenience of either having that debit card or that checkbook, it's not a place, Peter, to put a lot of our money because we're really not getting that much interest on it.
I think I'm getting 10 times the return on my checking account this year as opposed to last year, though, John. It went from 0.01% all the way up to 0.1% interest on my checking account this year. So I'm thrilled, right?
Well, yeah, but banks historically don't make a lot of money on checking accounts. Where they make their money on checking accounts is the overdraft fees.
Mm-hmm. And I've seen articles about the tens of billions of dollars a year that they do make on transaction and overdraft fees.
Well, having been in banking for 20 years, I can tell you that we used to say that overdraft fees were really inelastic. It didn't make any difference how much we charged. People were going to overdraw their accounts and pay the fees. And so it's a great moneymaker for the bank, but they don't pay a lot of interest, and it's not something that we should put a lot of money in. Now, I know we have a situation here in our local town where one of the banks has been acquired, and they're closing several branches. One community I know not too far from here, they're closing the only bank over there. And those people, have had a lot of things, a lot of changes. And one of them is that they're requiring a minimum balance in order to get free checking. Now, we can shop around so that we don't have to keep 25 or 50,000 in our checking account in order to get free checking. There are other banks, savings and loans, credit unions that do offer free checking, and we should always shop that, Peter.
Well, and John, having 25 or 50,000 in a checking account, earning even that generous 0.1% that I am earning, probably not the best utilization of many of those dollars. Now, some of them kind of necessity. I want to have that emergency account there, plus whatever I'm transacting on a monthly basis. But over and above about maybe an upper threshold of 6 months worth of regular monthly living expenses, those dollars are not doing their job to keep up with inflation and give me the growth that's necessary to maintain purchasing power.
No, I mean, with inflation, it's still over 6%. We have to make as much money as we can. And when we've got, 60 and 90-day T-bills and CDs that are paying higher than 4%, we certainly shouldn't leave a lot of our money in a checking account. And that's one of the things I encourage everybody out there is to look at your checking account. I know everybody wants to have that nest egg safety. I don't know why it is that my generation feels like that they're afraid to overdraw an account. But we're not going to overdraw it. We're going to balance that checkbook every month like we always do. But keep the minimum in there enough, like you said, 6 months worth of check writing each month, and then the rest of it, invest it. We've got to.
Well, they know the expense of those overdraft fees, John. That's why they balance the checkbook and don't overdraft on those accounts. But we've got to keep up with the purchasing power, which, John, in our financial progress, is where we turn to the plethora and multitude of other options that are out there. And we've got stocks, bonds, mutual funds, ETFs, and then bond funds. And we've got a whole different host of investment options that can be placed in different types of accounts. So if you would, could you maybe break down a few of these? What is a stock versus what is a bond versus what is a mutual fund versus what is an ETF? And where is each one particularly useful or advantageous, or where should we avoid one as opposed to the other?
Well, with the stock, what I'm doing is I'm actually buying ownership in the company. So I own a piece of the company. And if it's Apple, then I buy a share of Apple. I now have a piece of that company that I hold. The good thing about that is if Apple goes up, then my share price is going to go up, and I'm going to reap in the benefit of having that increased value. If Apple pays a dividend, then I'm going to get the dividend off of that share of stock. The bad thing is of course, Apple could go broke, just like Bed Bath & Beyond and some of the others have had to restructure. Then I could actually lose my investment. Or if the market goes down and I bought Apple at 180 and now it's trading at 140 and I need my money, then I have to take a loss in order to get my money. So it's a share of ownership, and I certainly nothing wrong with doing that, but we just have to be more careful and more conservative when we make those investments. With a bond, I'm loaning that company or an entity my money, and they're paying me back an interest rate. And so at maturity. So if I buy a bond, a short-term bond, then it'll be probably a T-bill or treasury bill, which is backed by the government. And at 6 months, 90 days, 6 months, whenever that bond matures, I'm going to get my money back plus my interest. Typically, we have to watch the interest rate on that, because when the stock market goes up, bond prices go down, and vice versa. So I can't really lose my principal. The only thing I can lose here is the opportunity cost if I buy a bond at 2 or 3% and the market goes higher. Now, if I buy a bond, which I'm loaning money to a corporation, then I'm backed by the corporation. They owe me money. They're my debtor. But if it's a 20-year bond and I need my money prior to the end of the 20 years, I may or may not get my investment back depending upon what interest rates are doing in the market. So we have to be careful there to underwrite the company, look and make sure that they're solid, check the interest rate environment, and then be able to put the money up for the period of time that we're looking at and feel like that unless something unusual comes about, I'm going to be willing to hold my money there during that period of time. So exchange traded funds, which are ETFs, they're a group of companies that this one entity has bought. And then that entity, they've gone out and they bought a bunch of stocks in companies that are emerging markets, pulled them together, and then I'm buying a piece of that. Now, the good news is I can get out every day like a stock. I can sell that anytime I want to. Stock market goes down, the emerging markets start trading off. I can sell that and get out of it The bad thing about it is I am subject to market loss. So if the market goes down, I could lose some of my money. Same thing with mutual funds. With mutual funds, I'm taking a sector, I'm buying a fund that has bought a bunch of stocks in that sector. And, if the market goes up, I make money. If the market goes down, I lose money. But instead of having my money in one stock, I may have it in 100 stocks. So it gives me diversity. The bad thing about mutual funds is I can't get out until 4 o'clock every afternoon when the market closes. So if the market's trading off, I have to wait until 4 o'clock to find out what that mutual fund is going to be priced at when they sell all those stocks at one time.
So stocks and bonds, there's the stock market, there's the bond market. The bond market actually much larger than the stock market as far as volume of dollars that are in bonds versus stocks. But the stock market gets most of the attention because it's more exciting, frankly. There's risk involved. It moves to a much greater degree, although even though the bonds and the bond market have been considered traditionally to be more conservative, John, in 2022, we saw volatility and losses on the bond and in the bond market as well.
Well, the bond market traded off almost as much as the stocks did in 2022. I mean, we saw bond mutual funds that were off 24% for the year and didn't recoup. It was an unusual market, Peter, where we saw that much volatility in all segments of the market, and there was really no place to hide other than cash. And so that doesn't happen very often, but it can happen. And certainly it's something we should look at. But we always should know what instrument we're buying and the pros and the cons to that instrument. And that's what we try to do here. We try to educate people. It's just like the Lunch and Learn that we just finished with a little while ago. We wanted our clients to understand the Secure Act 2.0 and be able to take advantage of it. People have to be educated so that they can make the best choices.
I do also hear some debate on mutual funds versus ETFs or exchange traded funds. And I know you addressed a little bit of that, John, but do you find that there is merit to the conversation and debate that's had over one being better or preferable to the other? You mentioned the 4 o'clock kind of trading. It doesn't trade throughout the day, but I hear there's some tax differences with mutual funds and ETFs as well.
Well, there are some tax differences. I mean, with the ETFs, if I trade today and I made a profit, then I've got to take that as capital gains. The bad problem with the mutual funds is that if I'm in an individual account, every year, whether I take money out of that mutual fund or not, they're going to declare capital gains and dividends, and I have to pay that. And so I never get to defer those capital gains and dividends. It's a little bit hard to use mutual funds. Mutual funds have been out since over 100 years, so they've been around a long time. They're very diversified. ETFs haven't been around that long, and we've gotten a variety of funds coming out under every ETFs on every subject. And I think that with time, you'll see a merging of the two markets so that we do more ETFs than mutual funds, but we're not there yet. ETFs have low cost, but mutual funds have also started cutting their cost and keeping them low. So I think there's a need for both of them. It just depends on your situation and what you're comfortable with.
John, a couple options that have gained pretty wide popularity and usage because they are intended to simplify the investment experience. But can you give us your take on pros and cons and utilization of life cycle funds or target date funds as well as index funds?
Well, an index fund is started with Vanguard, I think. Vanguard's been a big index company. And what I can do is take the S&P 500 and I index my mutual fund so that I try to stay in tune with what the S&P 500 is doing. The problem with that is because we over the years, the last several years, maybe 10 or 15, we've had these companies who've gotten really large. And so you take Apple and Microsoft, they're in the NASDAQ, but they're also in the Dow. And so you take a company like Amazon and Apple and Microsoft, those four of those tech stocks make up 80% of the S&P 500's weight. So because of their size. So really and truly, it's not an index of 500 funds. You're getting an index of the S&P 500, but really the top 5 funds control the majority of that index. So that's the reason that I don't really like indexing myself, just because I don't feel like I'm really getting a weight on the S&P 500. I'm really buying the top 5 funds and then hoping the rest of them don't pull it down or will help it pull up. On a target fund, let's say we take a target 2030. What that says is that I'm going to retire in 2030. And so because that's fairly close to present, I'm going to have more bonds than stocks. And therefore, it supposedly is safer. But what I found out with these target funds is they don't do as well as just individually investing in mutual funds and ETFs in the market. It's much better to be more conservative that way, I think, than be in these target funds. But that's the reason, they work really well in 401s, because the owner of the company has fiduciary responsibility to take care of the employees and to give them choices. So, you can say that the guy who's going to retire in 4 or 5 years needs to be more conservative. Nowadays, I'm not so sure that's actually true, because we have so much news and so much input, but we do limit trading in those accounts. So therefore, it just gives us a safer way to go.
So while they are intended to some extent to simplify the investment experience and decisions, can't be completely hands-off or asleep at the wheel. We've got to be paying attention, even if we are using and utilizing those target date funds or the life cycle funds or index funds. In other words, John.
No, we can't do that. We've got to be hands-on. The thing is, Peter, is we've talked on this show about taxes going up. We've talked about inflation. We've talked about that, retirement's not going to be, you're not going to need less money in retirement than you need now. So we have to be proactive throughout our career. And when we put that money up, it's not free money. It's our money. And we need to manage it and monitor it and nurture it so that it'll grow as much as it can, because we're going to need every bit of it at retirement.
Well, great segue, John. Let's talk about those tax status options that we have. Within some limits and limitations, we've got some choice of placement of those dollars, and even including, the option of stocks, bonds, mutual funds, ETFs, and target dates. Even those options can be placed inside of different tax statuses and tax buckets, we've called them before. What do we need to know there, and what are the benefits and disadvantages of those various options?
Well, there's only 3 buckets. We got the taxable bucket, the tax deferred bucket, and then the tax free bucket. Now, the one that we want that's the best for us, of course, is the tax free bucket. But there are only a few things that will give us tax free, and that's the Roth IRA, which, now we're able to have Roth 401ks without the mandatory distribution, which is great. And life insurance. Life insurance always passes tax-free, and we can take the cash value balance out without penalty or taxes, provided that the policy continues to go. So there are several of actions like that. Tax-free could also be municipal bonds. We can buy municipal bonds, but we have to be careful there to make sure that we're underwriting the municipality that's issuing those, usually by state and national and county government. So that's always tax free. Now, the tax deferred, of course, is your 401k, your Roth, your 403b, or not your Roth, your 403b, your 401k, and your individual IRA. We're going to let those grow, and then we're going to pay the taxes at the end. But we've been told that we should always try to go for the Roth if we can now, because we know that tax deferred is not the way we need to go. So the best options, tax-free, tax-deferred, and then taxable, we're going to pay the taxes every year. Now, if we're in a situation where we have a lot of income coming in, we've sold a piece of property, we have a bonus coming or whatever, then we need to be careful with that taxable because it could slide us into a higher tax bracket. We need to always look at those tax brackets to see where we are, how much room I have to go, and what's this investment going to do to me.
So many different choices and options. Got to have at least a good grasp and fundamental understanding on what your options are in order to make an educated, informed decision on the benefits, the disadvantages of placing dollars there and what type of account you are doing so. And John Kuykendall and his team can, of course, always provide the education, but also provide the recommendations on what are the best steps for you into working to achieve your goals. And John, I know that is a big part, as well as putting the plan together and saying, okay, now we've got the concept of how we're investing. Now we've got to watch it and manage it on an ongoing basis. And that's what you and your team do, helping your clients put the plan together and then making sure that it continues to work effectively toward achieving their goals and monitoring and adjusting for conditions along the way.
Well, that's right, Peter. When I started doing this 50 years ago, 20 years in banking, 31 years here. When I first got my job at the bank, the only thing I could open was a checking account. I went to the savings department and I said, I could open a savings account, but I didn't have enough money at the time to have a savings account, so I had to open the checking account. I saved up $1,000 and went to the new accounts desk and I said, look, I've got $1,000. I want to open a CD. I want a 1-year CD. And the lady looked at me, a sweet lady, and she said, John, you might as well open a savings account because it pays the same rate as that 1-year CD. And that was 4.5% in 1971. So, now we didn't have stock options. We didn't have mutual fund options. We didn't have all these things that we have now. It's very complicated and very complex, and you need a financial advisor to walk you through all this and make sure you're doing the best job. Whether it's us or someone else, I encourage everyone to get an expert to guide them. This isn't something, it's kind of like working on a new car. Unless you know how to get under that hood, you're not going to fix your car anymore. You're going to take it to an expert. And so why try to fix your finances? Take it to an expert.
Yep. And we've done full episodes previously on the different types of annuities. We've talked about life insurance in depth, the different types of life insurance. Why are there so many types, the benefits, disadvantages, the differences between them. And so if you'd like to go in depth on either of those topics, which I encourage you, again, to be well-versed on all of your options, you can go back in the podcast archives and listen to those. But John, I also want to preview an upcoming episode that we are going to do. We are planning on talking about this one next week, where there are now 14 states that are proposing to tax those, an additional tax if you do not have long-term care insurance. One state where that's already in place, 14 more at least that are proposing this. And there are some options there. There's some ability, thanks to the Secure Act, for individuals to get that in place, and in addition to supplementing their retirement accounts.
Well, that's right, Peter. Long-term care is a problem for a lot of states because a lot of people are going on Medicaid, which is putting a burden on the states. And because of the aging population and the fact we're living longer, long-term care is going to be more and more important. So these states have started imposing this tax, or either they're thinking about it, it's in legislation. And so what we want to do is be proactive and get our clients and our listeners out there the advice to go ahead and get started on this, because it's coming. It will be, in fact, something, Medicare and Social Security don't pay for long-term care. You have to have long-term care somewhere else. Now, in Florida, that's a problem. And we do have several hybrids that we can use that will qualify you for long-term care. But it's going to be a great segment. I'm looking forward to it, Peter. I think it's going to be something that a lot of people out there can get started with. And I'm really excited because the Secure Act makes it easy for people who are in a 401k and still young enough working that they can buy life insurance with one of these riders, that they'll be able to qualify for that long-term care, but it will actually be part of their 401k and they can take it out without penalty.
And avoiding that additional unnecessary tax and penalty. So we'll talk about that more in depth next week on the program. But in the meantime, if you've got questions, if you have concerns, if you'd like to put together that financially focused written retirement income plan, if you'd like a detailed review and analysis on all of your investment options and how you've deployed and set up your dollars to help you work to achieve your goals, pick up the phone, give John Kuykendall and his team there at Gulf Coast Financial Services a call, 386-755-9018. That is 386-755-9018, 386-755-9018. And John, I just downloaded this fantastic new guide you've got available about the Secure Act, the highlights and what we need to know about these legislative changes regarding our retirement right there from your website at GulfCoastFinancial.net. So more great resources there as always, GulfCoastFinancial.net. If you'd like to get up to speed on the Secure Act and the highlights that you need to know, go download the guide from GulfCoastFinancial.net. John, always a pleasure.
Thank you, Peter. Great to be here. Have a good week.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services, Inc., a registered investment advisor in Florida. Gulf Coast Financial Services, Inc. is not affiliated with Kovac Securities, Inc. or Kovac Advisors, Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.